Right now, though, we're going to look at one of the most stable nations in Africa, Ghana, which, thanks to cocoa and gold and then the discovery of oil, was on course to become one of the fastest growing economies in the world. And then it all went wrong. So wrong, in fact, it had to turn to the International Monetary Fund to help sort out its economic mess. The trouble started when Ghana began spending money before it began pumping oil. Debt, first of all, rose from $9 billion to $23 billion in just 3 years. And where Ghana had expected to earn as much as $5 billion by 2015, well, it's received less than $900 million between 2010 and 2012. It was all just way overestimated. Then, with all the imports coming in, Ghana's currency tumbled 40%, inflation rose to almost 14%. It's all meant an economy which was expected to expand 8% in 2013 could only manage 5.5%. Now, if all that just sounds like a bunch of numbers to you, have a look at the effect of them. I'm Boateng now with the proof of what Ghana's economic slide is doing to its own people.
Daniel Kissy has been in business for 22 years. He and his wife import clothing and shoes from Turkey and China. He makes his money in local currency, the Ghana cedi, but he has to pay for his goods in US dollars. The cedi has depreciated by about 40% against the dollar so far this year, and it's having a huge impact on Kissy's business.
Yeah, it's affected me dearly, because I used to change 29,000 for $10,000, and now I'm changing 39,000 for $10,000, the same $10,000. So you can imagine.
And people are so frustrated that they've even taken to the streets in protest. Everywhere you go, people are talking about the rising cost of living. Fuel has gone up more than 50% so far this year, and the cost of basic goods is also rocketing. In Malata Market in Accra, business is down. The market women say people just aren't spending.
It's really affecting us because when they come, the person has planned from the house to buy maybe a one or two. When it comes and the price has changed, she don't even buy it at all.
The country imports far more than it exports, so there's a massive demand for US dollars. That's depleting the country's foreign currency reserves and putting pressure on the local currency. The government also has a huge public sector wage bill. The country was initially reluctant to seek help from the International Monetary Fund, but one economist says it's the right decision.
Well, we have a situation where we have introduced a new pay structure that is consuming 70% of government revenue, for instance. So we don't have much for development expenditure. And then somehow the government maintains a whole array of subsidies, Now, it's been argued that that is not efficient. The IMF is going to help them, put in place this array of short-term stabilization measures. But over the long run also, we need to, try and address as I said, the weak economic fundamentals.
Ghana has traditionally relied on cocoa and gold exports to prop up the economy, but over the past few years, global commodity prices have fallen. Experts say the country needs to diversify and grow its manufacturing sector to boost earnings from exports. In the short term, the government also needs to cut spending, and that's likely to be unpopular. People like Kissy just want things to get better, but it's going to be a difficult journey that requires a lot of political will.
Yep, and some smart economic thinking too. Joining us from London to discuss it all is Angus Downey. He's the head of economic research at the West African bank, Ecobank. Angus, what is the story here? Ghana was looking pretty good there for a while. Has it simply been a case of spending the money before they had it? It looks like that.
Well, I think yes, in some ways, but I don't think everything's broken in the economy. I mean, they've got some quite good indicators that you can talk about and quite strong domestic demand that's ongoing. But yes, I think the root of the problem was that they were spending quite a lot of money at central and local government levels, and also they weren't raising enough tax revenues. So this is what led to these large fiscal deficits. And with that, you also were getting a large level of current account deficit building up over the last couple of years. And so I think a lot of investors were thinking, well, this doesn't look very sustainable. So that was leading to a lot of currency depreciation.
How manageable would you call these debts and deficits? When we've looked at recent cases of debts, most of them have been Europe and most of them have been pretty horrific. How bad would you call Ghana's debts? Are they, as I say, are they manageable?
Well, they've managed thus far, but it's not something that can be sustained indefinitely. When you've got a fiscal deficit of around 9% of GDP, which it currently is at the moment, that's come down slightly. It was at probably close to 12% about 18 months ago. And really anything that's over 5% of GDP, you've got to think, well, how is the government going to work its way out of this position? So it needs a strategy. It takes several years to get out of a hole that you've dug yourself into of that magnitude of around 5% of GDP as a rule of thumb. So when you're at 10, 11, 12% of GDP, then that really is a big problem. And I think all the factors that have driven the government to talk to the IMF and agree on trying to arrive at a solution have really been the result of this unsustainability of the fiscal position.
Well, I'm glad you brought up the IMF, the International Monetary Fund, because that was going to be my next question. What could happen there? You kind of always feel that the International Monetary Fund is this bank of last resort. It's, when things need fixing immediately, not necessarily an answer to problems.
I would disagree in some ways, because I think, yes, it's kind of a last resort that Ghana's had to engage with the IMF, because if we cast our mind back to March or April this year, there was talk about a domestic reform agenda being created within government. We never really saw much detail of that, and many of the indicators continued to deteriorate, including the exchange rate. So that led the government to engage with the IMF formally, and I think at the moment we have an IMF mission in Accra talking to the government, identifying what are some of the main issues that have to be corrected and what are the corrections that need to be put in place. But I think the IMF has got a longer term role. They're not just firefighters coming in looking to put out the flames and then they leave again. And you've got to also remember that the IMF have got a resident representative based in Accra. He's been there a number of years. But also that there is ongoing technical assistance provided by the IMF through its various departments, fiscal affairs, monetary and capital markets and so on. And that engagement is long term, and that will continue even after this current programme of support and help that the IMF are looking to provide ends. So I think really the IMF is a long-term partner. It's there to help its member countries, and this shouldn't be seen as a short-term palliative. It's more part of a longer-term perspective and strategy to help the Ghanaian authorities move forward and continue to grow the economy in a sustainable way and achieve this higher level of middle-income status that they recently got to.
Angus, I believe you were previously with the Africa Development Bank, and I wonder, given that previous role, if you could give us a bit more insight into Ghana. It is not a country which we hear an awful lot about, so I'm keen to understand about things like the infrastructure, the roads and the infrastructure, the hospitals, the healthcare, all these sorts of things which need to be looked after and are central to a country's growth.
Absolutely. I mean, without infrastructure, you can't really function as an economy, and you need it at both the basic level, roads, port facilities, airports, railways, which Ghana has, but also you need up-to-date new technology with regard to telecoms, for example. And Ghana has got quite a lot of that when you compare it to some of the other countries within Africa. But I think there's this infrastructure deficit, and we've heard a lot about that, not just in Ghana, but also elsewhere on the continent. And I think the World Bank reckons somewhere around nearly $100 billion per year is required to bridge that deficit gap. So $100 billion per year is needed to provide new infrastructure as well as rehabilitate existing infrastructure across the continent. When we look at Ghana specifically, it probably could do with something in the region of 8 to 10 billion alone, because it's quite a large population, a relatively large country, and the road infrastructure, whilst it's relatively good compared to some of its peers on the continent, there could be improvements across the board, not only just on roads, but also transport infrastructure, as well as telecoms and access to the internet and so forth. So infrastructure is hugely important, and it's one part of helping to create the correct economic environment that allows the private sector to flourish, consumers to buy goods and services. And so without that infrastructure in place, you're going to always struggle.
All right, Angus Downey talking Ghana with us this week. Thank you for your time, Angus.